Welcome to Gold Bank.
Glad to be here.
We are thrilled to have you joining us right now. Whenever you look at gold and silver exposure through mining stocks, especially if you are part of a UK audience tracking corporate results, gives you absolute clarity.
It really does.
Yeah, it gives you clear, undeniable indicators of overall market health. You cannot just look at the ticker price of the metals on a screen. You really have to look at the actual machinery of the companies pulling those metals out of the earth.
Exactly. The spot price of gold or silver, it tells you what the metal is worth today. But the corporate results tell you the reality of what it actually cost to get it out of the ground, to process it, and to physically return capital to shareholders.
Right.
So for you, anyone managing a UK portfolio and wanting to truly understand their precious metals exposure, the corporate financial statements are where the reality check happens.
That is exactly what we are doing today. We are going to set the agenda for the next 20 to 25 minutes. We will focus strictly on the headline news regarding Fresnillo's latest financial results.
Which are quite something.
They are. And after we unpack those numbers, we're going to break down the specific winners and losers across the entire UK-listed precious metals landscape. Our aim here is to simply connect the dots for you. We want to show how mining companies are navigating the current pricing environment. And, we are going to do this without overstating the impact of any single piece of news.
Yeah, we don't need to exaggerate.
Exactly. No exaggeration needed. We are just looking at the facts, the numbers, and what they fundamentally mean for your portfolio.
It is so crucial to maintain that grounded perspective.
Yeah.
I mean, every earnings report just provides data points.
Right.
And when we string those data points together, we start to see patterns. We see how operational costs, capital expenditures, and commodity prices interact. We are examining the ongoing narrative of the mining sector, really looking at how management teams allocate capital when the environment is highly favorable.
So let's unpack this headline right away. We are talking about Fresnillo PLC and their financial performance, and the numbers here are eye-catching.
To put it mildly.
Yeah. Pre-tax profit more than doubled. It jumped from $743.9 million to $2.08 billion.
Wow.
Just let that sink in for a moment for you. Furthermore, their revenue rose 31% to hit $4.56 billion. And off the back of those numbers, the company proposed its highest dividend since listing.
Right.
When you see a pre-tax profit leaping from the $700 million range to over $2 billion, it grabs your attention immediately.
It certainly stands out on a balance sheet. The mechanics behind that profit jump reveal a whole lot about the current state of the industry.
They do.
The surge was primarily driven by stronger gold and silver prices. But what is vital for you to understand is that these higher realized prices effectively mask the fact that lower metal volumes were actually sold.
Oh, so less physical metal.
Exactly. They moved less physical product out of the mine, but because the global market price for that product was so robust, their revenue and profits expanded dramatically.
That feels like the ultimate magic trick of a high-priced commodity environment. You are moving less material out the door, you are processing fewer tons of ore, yet the cash register is ringing louder than ever.
It is a great position to be in.
It makes me wonder about the operations themselves. Are they just sitting back and letting the metal prices do all the heavy lifting, or is there a fundamental shift in how they run the business?
Well, the broader macroeconomic environment is definitely doing a lot of the work. But management deserves credit for controlling the variables within their grasp.
Sure.
A high-price environment wasn't the sole factor driving that $2.08 billion pre-tax profit.
Yeah.
We have to look at two additional very critical drivers at play here.
Okay, let's hear them.
First, the company executed strategic cost reductions.
Right.
They actively managed their operational overhead, which means tightening up supply chains, negotiating better rates for consumables, and maximizing the efficiency of their labor force.
That makes sense.
And second, they benefited from a favorable peso effect on their operational expenses.
Okay, let's break down that peso effect for the listener, because currency dynamics often confuse people who are purely focused on the metal itself.
Yeah, FX can be tricky.
Fresnillo is operating in Mexico. That means they are paying their workers, their local contractors, and their regional suppliers in Mexican pesos.
Correct.
However, when they sell their refined gold and silver, they are selling it on the global market, and that transaction is priced in U.S. dollars.
That currency dynamic is a massive tailwind when it aligns properly.
Massive.
When the local currency, the peso, in this case is favorable relative to the U.S. dollar, the company's local operating costs decrease when translated back into their dollar-denominated financial statement.
Right.
They're earning top-tier U.S. dollars for their ounces, while effectively paying comparatively less for the labor, electricity, and local materials required to produce those ounces.
It's a dual benefit.
Exactly.
Yeah.
When you combine that currency advantage with deliberate strategic cost reductions, you get a powerful multiplier effect on profitability.
It is like running a business where your customers are paying you in a premium currency, but your landlord and your employees are accepting a currency that costs you less to acquire.
That is a perfect way to put it.
This serves as a textbook example for investors. It shows you exactly how a high-price environment for metals can substantially expand profit margins, even when the actual volume of metal moving out the door softens. You have revenue going up because of the metal price and costs being squeezed down through strategy and currency fluctuations. The gap in the middle, the profit margin, just widens beautifully.
The operating leverage works entirely in their favor under these conditions. Yeah. Every additional dollar in the gold or silver price falls almost directly to the bottom line.
Which allows for the dividend.
Exactly, allowing them to propose that record dividend.
Right.
It reinforces why investors look to equities for leverage on the underlying commodity.
Right,
Yeah. If you own a physical silver bar, a 10% rise in silver gives you a 10% gain. But if you own a miner like Fresnillo, a 10% rise in the metal price might result in a 50% jump in free cash flow, simply because their fixed costs are already covered.
Which brings us to a massive disconnect that we need to address right now. We just walked through a massive profit jump to $2.08 billion.
Yeah.
We discussed a 31% revenue increase. We highlighted a record dividend. Yet, despite all of that incredibly positive news, Fresnillo's shares actually dropped 2.7% on the morning of the announcement.
They did.
For anyone watching the ticker, that feels entirely counterintuitive. How do you deliver a record dividend, double your profits, and watch your stock drop when the market opens?
Well, market psychology is relentlessly forward-looking.
Always.
While the prior year's numbers were stellar and the dividend was a fantastic reward for current shareholders, traders and institutional investors were already looking past the rearview mirror.
They were looking at guidance.
Yes. They were immediately digesting the upcoming production guidance and, more importantly, the capital spending plans required to keep the machinery running.
Let's lay out that guidance for the listener to see what the market was evaluating. For 2026, Fresnillo expects to produce between 42.0 and 46.5 million ounces of silver and between 500,000 and 550,000 ounces of gold.
Right.
That is the production side of the equation. It outlines the physical metal they expect to pull from the earth, but the expenditure side of the ledger is what really seemed to spook the traders.
The upcoming expenditures shifted the entire narrative for the stock.
How so?
Well, Fresnillo guided their capital expenditure, commonly known as Capex, at around $765 million for 2026.
That is huge.
It is. And on top of that massive figure, their exploration spend is expected to hit $260 million. When you add those numbers together, you're looking at over $1 billion in planned spending for the upcoming year alone.
Over $1 billion in spending just to maintain and slightly expand their operations. And part of that exploration spend includes drilling activities at Probe Gold.
Correct.
Let's pause and explain that because it is crucial context. Probe Gold is an exploration company focused on acquiring and developing highly prospective gold properties. When a major producer like Fresnillo allocates capital toward exploration with an entity like Probe Gold, they are essentially funding the search for future ounces to replace the ones they are currently mining.
Exactly.
It involves sending rigs out into the field, drilling core samples deep into the bedrock, and sending those samples to assay labs to see if the dirt holds economic value.
The lifeblood of any mining company is its reserves.
Right.
Every ounce you pull out of the ground is an ounce you no longer have in inventory. You have to constantly spend money to find new ounces, which is why exploration budgets are so critical.
You can't just stop looking.
No, you can't. But from a trader's perspective, that $260 million exploration budget, combined with the $765 million in general capex for things like heavy machinery, ventilation systems, and mine shaft expansions, well, that represents cash that is not going into the shareholder's pocket.
Right on cue, we saw analyst intervention regarding those spending figures. JPMorgan flagged this specific capex guidance as being higher than their own internal forecast.
They did.
When a major financial institution like JPMorgan points out that a company intends to spend more money than the financial models predicted, the market reacts instantly.
The tension here is entirely between earnings and spending. Institutional investors build incredibly complex discounted cash flow models to value these companies.
Sure.
When a company announces that their capex will be higher than expected, the analysts have to update their spreadsheets. Higher costs mean lower future free cash flow, which directly reduces the present value of the company in those models.
So it's a math problem for them.
Exactly. The market saw the record dividend, acknowledged the $2.08 billion profit, but immediately fixated heavily on that 2026 capex intensity.
It all boils down to free cash flow. If the
Wow.
money is going into the ground, whether that is buying a fleet of new haul trucks, building a new processing facility, or drilling countless holes at Probe Gold, it limits the capital available for future dividends and share buybacks.
This raises a vital point for UK portfolios. It is a crucial reminder that mining equities can often lag behind physical metal prices.
That is such an important distinction.
You might have gold and silver prices sitting at robust near-record levels, but if the mining company has to reinvest a massive portion of its revenue just to sustain its production profile, the equity valuation will re-rate based on that new reality.
Right.
The shares will not necessarily track the metal price on a one-to-one basis when future spending requirements alter the cash return narrative.
It highlights the fundamental difference between owning the metal and owning the miner.
Absolutely.
The physical metal sits in a vault and requires nothing but a small storage fee. The mine is a living, breathing, industrial beast that needs constant feeding with capital, labor, and diesel fuel.
A very hungry beast.
Let's transition into our breakdown of the specific winners and losers across the UK-listed precious metals landscape based on this current environment. We will start by categorizing Fresnillo as a winner despite the market's reaction to their forward-looking guidance.
I agree. Fresnillo remains a clear winner based on their operational performance. Their leverage to gold and silver prices is undeniable.
The numbers prove it.
They do. Yeah. The higher realized prices translated directly into a record payout for shareholders. They demonstrated that when the macroeconomic conditions are right, their asset base can generate massive amounts of cash.
Yeah.
They capitalized on the environment perfectly.
They pulled the levers they could, controlling costs, maximizing the currency advantage, and riding the price wave to reward their shareholders with that dividend. You cannot ignore that kind of tangible return.
No, you can't.
Another winner on our list, perhaps surprisingly for some listeners, is JPMorgan. How do major financial institutions act as winners on big corporate results days?
The victory for major banks comes down to market influence and the sheer demand for their analysis.
Yep.
When a company releases complex financials, especially ones with conflicting signals like record profits running alongside higher than expected future costs, investor focus naturally gravitates toward analyst forecasts and guidance interpretations.
Right. People need someone to make sense of it.
Exactly. The market relies on institutions like JPMorgan to dissect the Capex plans and determine the corporate valuation. Their commentary drives the narrative and dictates the flow of institutional capital.
They act as the ultimate filter for the market. When the raw data hits the wire, nobody knows quite what to make of the billion-dollar spending plan until an analyst desk runs the numbers and issues a note.
Precisely.
When JPMorgan flags the Capex, every portfolio manager in the City of London pays attention. Their role as the interpreter of complex mining financials solidifies their position in the ecosystem.
They are indispensable in that regard.
Moving on to our third winner, let's talk about Greatland Resources.
Yeah.
What is driving their current momentum in the market?
Greatland Resources is a prime example of a company being rewarded for an aggressive growth narrative.
Growth is key for them right now.
Their momentum is currently being driven by their expansion plans at Telfer, combined with their heavy exploration budgeting.
Let's give the listeners some context on Telfer. Telfer is a massive, established copper-gold mine located out in the Paterson province of Western Australia.
It is a massive operation.
It is a legendary asset in a Tier 1 mining jurisdiction. When Greatland Resources pushes forward with expansion plans at a site like Telfer, they are talking about moving astronomical amounts of earth, extending the life of the mine, and tapping into new ore bodies.
Right.
So while the market penalized Fresnillo slightly for their spending plans, it is actively rewarding Greatland for theirs.
The psychology of a bull market dictates how capital expenditure is viewed.
That's a great point.
When metal prices are high, investors become hungry for growth. They want exposure to future discoveries and expanded operations. They want to see companies aggressively expanding their footprint, finding new ounces, and increasing their future production profile.
So spending is good if it's for growth.
Yes. Greatland's commitment to exploration and their expansion at Telfer fits that desire perfectly. The market is willing to fund and reward heavy exploration budgeting because the potential payoff at current metal prices is perceived to be vast.
It all comes down to the stage of the company's life cycle.
Exactly.
Fresnillo is viewed as a mature, massive producer. When they spend money, the market worries they're just running on a treadmill, spending billions just to maintain their current size.
It's a standstill?
Right. But Greatland is viewed as the aggressive expander, scaling up an iconic asset. Both companies are spending heavy capital, but the market interprets that spending entirely differently based on the narrative of growth versus maintenance.
That narrative shift is everything in mining equities.
We must also look at the other side of the ledger. Let's move into the losers in the current landscape, starting with Johnson Matthey. What happened with their Catalyst Technologies unit?
The situation with Johnson Matthey centers entirely around value realization or the painful lack thereof. They recently sold their Catalyst Technologies unit to Honeywell. The critical detail for investors to grasp is that the sale price was drastically cut following weaker performance by the unit.
Let's clarify what this unit actually does so the listener understands the gravity of the sale. Johnson Matthey is deeply involved in PGM-linked industrial businesses.
Right.
PGM stands for Platinum Group Metals, which includes elements like platinum, palladium, and rhodium. These metals are essential for chemical reactions, particularly in catalytic converters for vehicles, but also in broader industrial chemical processes and emerging green hydrogen technologies.
They're very specialized.
Very. The Catalyst Technologies unit develops the complex chemical processes that utilize these metals for industrial applications.
When you have an agreed upon or expected valuation for a highly specialized business unit like Catalyst Technologies, and then you are forced to accept a drastically cut sale price just to finalize the deal with Honeywell, it sends a very clear negative signal to the broader market.
It shows weakness.
It indicates a severe headwind for value realization within PGM-linked industrial businesses.
It forces every analyst and investor to update their models. If a legacy player like Johnson Matthey couldn't realize the value they thought was inherently there, who else might be overestimating the worth of their PGM assets?
Exactly. It casts a shadow over the whole subsector.
It shakes the confidence in the sector and makes investors question the underlying valuations of similar operations across the board.
It definitely does.
Next on our list of companies facing headwinds is Hochschild Mining. Now, this one is compelling because their recent stock strength has actually been quite robust, buoyed by the high metal prices across the sector.
True.
So why are we evaluating them as a loser in this specific context?
The contrast between their recent stock performance and their future outlook is the core issue here.
Okay.
You have stock that has enjoyed the powerful tailwinds of high metal prices, but their 2026 guidance is highly concerning. The company provided commentary flagging potential output declines combined with higher operational costs.
Output declines and higher costs represent the absolute worst combination for a mining operation.
It is a toxic mix.
It is the exact opposite of the operating leverage we discussed with Fresnillo earlier. Let's think about the physical reality of a mine-facing output declines. It usually means the grades of the ore are dropping.
Almost always.
You have to blast, haul, and crush more tons of rock just to get the same amount of gold or silver. That requires more diesel, more labor hours, and more wear and tear on the machinery.
And all of that costs money.
If you are pulling less metal out of the ground, and it is costing you more money to process every ton of dirt, your profit margins are going to get squeezed incredibly fast.
That dynamic exposes the vulnerability of the operation. Right now, the high metal prices are acting as a protective shield, covering up those underlying operational weaknesses.
Masking the problem.
Exactly. The revenue looks fine because the gold price is elevated. But if the broader metal prices happen to cool down or revert to historical averages, the combination of declining output and rising costs threatens to squeeze margins violently.
It is a precarious position.
Very precarious. When the market realizes that the fundamental cost per ounce is rising while the output is shrinking, investor sentiment can sour very quickly.
It forces you to always look under the hood of the corporate results. A rising tide lifts all boats, and high commodity prices can make a struggling operation look highly profitable for a short period.
Temporarily, yes.
But the guidance provided by Hochschild is telling the market that the physical fundamentals, the actual moving of dirt and rock, are getting harder and more expensive.
It is a red flag you cannot ignore.
Finally, let's address Valterra Platinum. This brings a completely different type of risk to our discussion.
Hmm.
We are moving away from purely operational or geological challenges and looking squarely at clear country and policy risks.
This is a major factor for UK investors looking abroad.
What is happening in Zimbabwe with Valterra?
Valterra Platinum is facing severe repatriation friction. Specifically, there are acute issues regarding Zimbabwe export proceeds repayments and an existing backlog. They're operating in a jurisdiction where the local government and the central bank exert strict controls over foreign exchange. In simple terms, getting the financial proceeds of their exported metals back into their own hands in a usable global currency is proving to be incredibly difficult.
This highlights the ultimate geopolitical risk in the mining sector. You can possess the highest grade mine in the world, operate with the lowest costs in the industry, and sell into a market with the highest metal prices in history.
But it doesn't matter if you can't get the cash.
Right. If the local government or central bank restricts your ability to move your export proceeds out of the country, the value of that operation plummets.
The central bank in Zimbabwe requires exporters to surrender a portion of their foreign currency earnings in exchange for a local currency, often at rates that do not reflect the true economic reality.
That is a tough environment.
It is. When there's a backlog in these export proceeds repayments, the mining company essentially has its capital trapped. This specific type of repatriation friction acts as a heavy weight on valuation multiples.
Investors hate uncertainty.
They do. The market will always heavily discount an asset if there is uncertainty about whether the cash generated by that asset can actually be distributed to shareholders or reinvested globally.
Investors are simply not willing to pay a premium for trapped cash. It does not matter how strong the broader PGM market tape is. If the capital cannot leave the country, the equity will suffer.
It is a harsh reality of global mining.
It really is, where you are entirely at the mercy of the host country's financial policies.
You have to factor in the jurisdiction just as much as the geology.
Let's step back and synthesize the core lesson here for UK investors navigating this landscape. Tracking these corporate results provides a roadmap of the sector's health.
It gives you the full picture.
We saw Fresnillo demonstrate undeniable pricing power and strict cost control. They successfully turned a favorable macroeconomic environment into massive cash generation and a record dividend payout.
Yet the market remains relentlessly focused on the future. The immediate negative reaction to Fresnillo's stellar numbers prove that traders are fixated on how higher capital expenditures in 2026 will eat into future free cash flow. They weighed the billion-dollar spending plans against the current profits and decided the future costs warranted a lower equity valuation today.
That push and pull is the exact tension driving this market. You have strong metal prices on one side of the scale generating massive revenue.
Right.
On the other side of the scale, you have heavy operational spending demands, relentless Capex requirements, and rising costs. That dynamic is the engine driving volatility across all UK-listed precious metals miners.
It is universal across the sector.
Whether it is Fresnillo's massive Capex budget, Hochschild's rising costs and declining grades, or Greatland's aggressive exploration budget at Telfer, capital intensity is the defining feature of the industry right now.
It requires investors to look far beyond the spot price of gold and silver on their screens.
You really have to.
You must evaluate the corporate machinery, assess regional and geopolitical risks, like the repatriation friction we saw with Valterra in Zimbabwe, and critically analyze the forward-looking guidance. The mining equities offer incredible leverage to the upside, but they also introduce complex layers of operational, financial, and political risk that the physical metals simply do not possess.
As the costs to pull ounces out of the ground continue to rise across the board, whether through lower ore grades, higher labor and energy costs, or massive Capex requirements to build deeper shafts, how long can high metal prices shield mining companies from the fundamental realities of capital-intensive exploration?
That is the million-dollar question.
And at what point do investors simply choose to hold the physical metals, avoiding the corporate machinery entirely instead of taking on the multifaceted risks of mining equities? It is a crucial dynamic to monitor as capital continues to flow through the sector. Thank you for joining our discussion today.